Right, learners, an adjustment that you will often come across is that of provision for bad debts. Now, I want to explain this concept because it's not the easiest concept, but I need to relate it back to what we did with depreciation. Both of these are using the concept of prudence. In other words, in your valuation in your books, you need to be realistic. And so our assets need to be valued at a realistic price. So you remember that if we had a vehicle, and let's say the cost of that was 200,000, we know that this vehicle is going to lose value over a period of time. And so we created a negative asset account called accumulated depreciation on vehicles. Now, it was a negative asset account because it's going to reduce the asset. And so if I, for example, was going to reduce this by 20% on cost, I would then write off an amount of 40,000. The point of doing this is in your balance sheet, you would sit and say, right, I had a vehicle that cost me that, but it's been depreciated by 40,000. So it's only worth 160,000, a more realistic value and in terms of prudence. Now the double entry for this, remember we would have created an expense account, and being an expense account we would have debited depreciation. So there's the double entry, debiting an expense and crediting the accumulated account, which is a negative asset. This depreciation account is an expense for this year, and so you would close off the 40,000 to the profit and loss account, and that means it'll reduce your profit from this year. Another way of looking at this is that we're converting this asset into an expense. The vehicle is losing value, and that loss in value is becoming your expense. If you go on to the next year then, again, we would depreciate by another 40,000, and again we would debit our depreciation, our expense account. In our balance sheet, our vehicle would be valued at the original 200 minus 80, so the value has now gone down to 120. And your expense for the next year would have been another 40,000. So what we're trying to do is show our asset at a realistic figure. Right, now another asset that we have to look at is that of our debtors control. Remember, these debtors are people that owe you money. And we know from past trends in most businesses that it's very often that we don't get the full amount of this because there's a thing called bad debts. Now, while businesses will screen their debtors and do everything to try and overcome bad debts, reality tells us that, especially in the economic climate, not all your debtors always pay you. So the first thing we would always do is we would look at our debtors, and if we've got any specific debtors that haven't paid for a long time or you can't trace, you would write off the bad debts. That would be allocated to a specific debtor. So you'd have an expense, bad debts, and you would decrease your debtors. Now, let's assume that I've got debtors with a balance of 30,000 in my books. So this after I've written off the bad debts. What am I doing is assuming that this 30,000 is going to come in, and I'll have that cash through my current assets in order to pay off my current liabilities. Think of your current ratio or your asset test ratio. You are planning for the future to pay off debts, and you are assuming that this full amount comes in. Now, reality is that it doesn't always come in. And statisticians in a business will go through the past trends, and they'll have a look and see, on an average, what percentage of your debtors don't pay. And we're going to set up a provision for bad debts. Now, this will be a negative asset account, same as accumulated depreciation. And so our debtors, we maybe, let's say, we make that 3,000 Rand, 10%. What we will do in our balance sheet is say that our debtors are only expected to bring in 27,000. If they happen to bring in more, that's fine. It's always good to be a little bit pessimistic and not to bank on getting it all if you don't get it. But if you do get it all, well, that's just a real bonus, and it's the better situation to be in. So let's have a look now how this affects our entry. So, as I said, I've got a debtors control with 30,000. I'm looking at the year ended 20.5. So it's the end of February, and my debtors owe me 30,000. The statisticians tell us that about 10% of your debtors won't pay. Now, you will not have to come up with this 10%. It will be given to you. That's beyond our school syllabus. Now, what we need to do is 10% is 3,000. We want to decrease this. Just like we depreciated our assets, we want to decrease this amount by saying there is a possibility that 10% won't pay. And so we are going to open up a provision for bad debts account. This is a negative asset account. So in your balance sheet, you'll say, right, under current assets, I've got debtors of 30,000, less my provision, and using prudence, you're saying, right, let's only bank on getting 27,000. Now, this is a perfectly legitimate transaction in a business. Nobody's doing any fraud at this stage. SARS allows this because they know that bad debts is a reality for most businesses. But now, if we've credited this negative asset account, we obviously need a debit. And the same as we did with our depreciation, we're going to put it into an expense account. And my expense account then is called a provision for bad debts adjustment. Now, that's what's dividing these two. You see this where it's got the adjustment, that's the expense account. And so we will have provision for bad debts here, as where my double entry is, with the 3,000. And obviously in this account, it would have been provision for bad debts adjustment. Now, I know this is a long name, and I'm busy abbreviating here, but you're not supposed to abbreviate, remember. You have to use the full account. You have to bring in the word adjustment, because that is the name of the account. This is an expense account, and so at the end of February 20.5, we will write off to the profit and loss 3,000. What we're saying is there's a potential bad debt, potential expense on our debtors for this year of 3,000, and the effect will be to reduce your net profit. Same as we did with depreciation. And in our balance sheet, as I said, we would now have 30,000 less the 3,000, a value of 27. Right, now that's fine. Now let's go to a year later. So in the next year, we'll be selling goods to our debtors. This will be increasing. They'll be paying us. There'll be returns, so it's decreasing. And this will change throughout the year. And now we get to the end of 20.6, February 20.6, and let's say I've now got a balance in this account of 40,000. Our provision for bad debts has been calculated to be 10%. So 10% of this is now 4,000. Now this is where it's going to go a bit different from depreciation. In the case of your vehicle's cost stayed the same. My example just now is 200,000. So every year you write off 20%, so every year you're going to write off 40,000. In the case of debtors, this amount is not fixed because your debtors are current assets, not fixed assets, and they are changing throughout the year. At the end of the year, you're now showing a 40,000. You want your provision to be 10% of that, 4,000. At this stage, we've already got 3,000 in here. And so all we're going to do is increase it by 1,000 so that the balance on this account now comes 4,000. That means that in your balance sheet for 20.6, you'd say my debtors are 40,000 less my provision of 4,000. In other words, a realistic figure of 36,000. But now this 1,000 Rand was the extra that we added on. And that will go to the same expense account, but remember we're a year later now, and we'll bring in the 1,000 Rand. This is where the adjustment comes in. We are adjusting the provision. The first year we had to set it up of 3,000, so the whole amount was the adjustment, was the whole amount coming in. The next year we are adjusting that to bring it up to the new figure. So in exactly the same way, I would have my double entry, provision for bad debts here, debit the expense account, and over here provision, and this is remember 20.6, provision for bad debts adjustment. And again, at the end of 20.6, to your profit and loss, you would have an expense of this year of 1,000. So you've already wrote off 3,000 as an expense last year, and this year we're adding on an extra expense of 1,000, so that this provision is equal to 10% of your debtors. So now let's go another year later. Again, you start the year with 40,000. You're going to be selling to your debtors. They're going to be paying you. They're returning goods. You're giving them discount and so on. And by the end of the year, 12 months later, your debtors are now only 25,000. Again, your provision must be 10% of that. 10% of that is 2,500. Now, if we look at this provision for bad debts account, we've got a balance of 4. We need to adjust this so that the balance is equal to 2,500, the 10% of your debtors. So in this case, I'm going to have to minus off this. So I'm going to have here, now this is 20.7, I'm going to have a provision for bad debts adjustment, 4,000 minus 2,500, which it must be, you are going to have to adjust by 1,500. So that your balance here, your balance carried down now, 2,500, and that will come down for the next year. The double entry for this 1,500, because you reduced it, it was on the debit side here, is going to go onto the credit side of the adjustment account. So you're going to have provision for bad debts of 1,500. Now, this is on the credit side. It's no longer going to be an expense account. It's actually becoming an income. It's almost like a negative expense. You have already written off expenses in previous year of 4,000. That is now too high in relation to your debtors for this year. And you want to cancel some of those previous provisions that you wrote off. So you're going to create an income of 1,500, which will get closed off to the profit and loss account, but it's going to go under your other income. So together with your discount received, your rent income, your commission income, this is going to be an income. Expenses that you wrote off in previous years is being cancelled. So you're now creating an income. Similar concept to if you wrote off a bad debt, which was an expense, and you now got that money in, you would create an income called bad debts recovered, which would be cancelling some of the previous expenses. So this is important now. This account closes off as an income. When you go to your balance sheet now in 20.7, you're going to say your debtors is 25,000, less the provision, this is coming down onto the side of 2,500, and so your realistic figure for your debtors would be 22,500. Now I know this can become a bit confusing. The important thing here is that you have to adjust. So you've already got a balance, and you've got to look how much you need to adjust it by. If you're increasing it, there is an increase in an expense. If you are going to decrease it, then it becomes an income. Now, it's not the easiest concept, so you need to really focus and try and sort out this adjustment.